All right. Hello, everyone. Thank you so much for joining us today. My name is Tara Spalding. I'm the Managing Director over at Boom Startup Accelerator. Thank you for joining us on this OpenUp session. And this is a really exciting session because it's to help entrepreneurs figure out if what they're building is investable. Today, I have two very special guests. And I'll go into their introductions a little later, but why don't we just have a quick hello from Robert Bell, who is the venture partner at Ideaship and is also the lead organizer for 1 Million Cups here in Salt Lake City.
Hi, everybody. Robert Bell here. Happy to be here with our friend Andy and Tara. So anything we can do to connect with the community and share more about how to think about capital is a great thing. So happy to be part of it.
Robert, I'm so glad you're here. Thank you. It's also my pleasure to introduce Andy Jorgensen. He is one of the head investors at SLC Angels and also runs Lighthouse Ventures and also VentureWorks. Andy, thank you so much for being our investor guest of honor today.
Hi, everybody. Nice to meet you. And I've been in sort of the pre-seed to Series A space for the last 10 years. So I've seen a lot of ideas been brought to life, and hopefully we can help you guys on your journey as well.
And both of these fine people are Boom Startup mentors. So if anything comes up during this program and you'd like to connect with them afterwards, of course, go directly through LinkedIn to connect with them, or you connect with them through Boom Startup as well. Before we begin the webinar, I'd love to communicate that we want to make this as interactive as possible. Please submit your questions into the chat. Christina is here helping us today. Christina, please say hi.
Hi, everyone.
She's awesome, and she's going to be interjecting your questions into our discussions. And also the session is recorded, so if you miss anything, of course, you can watch it later. Before we continue, I'd love to thank our sponsors very much. Without these sponsors, we wouldn't be able to do these free programs. So thank you to Assure, Stoll Reeves, Now CFO, and Outcode. Now, if you're new to Boom Startup Accelerator, our whole purpose is to give aha moments to every single startup that gets involved with us. And we're on track to work with over 1,000 founders this year. Boom Startup helps you break through the barriers that are holding you and your company back. And we really like the do-it-yourself, commit with grit sort of entrepreneur. You'll find out that the Boom Startup Accelerator is radically different because we serve a global startup community across several different industries and different business models. We are an open and opt-in accelerator. We're not a closed cohort requiring capital and equity exchange at the very beginning. And so all of these programs are for you to help you out to grow your business when it's applicable. How Boom Startup measures success is very unique. Of course, we go towards that education through programs such as this, where these learning opportunities can help you create more revenue, optimize your business spends and performance, and also your go-to-market strategy. And then this one is what we would consider more on the teal bucket, which is setting your company up for funding. And we also help you vouch for authenticity. If you haven't already, please participate in our quarterly business surveys. And of course, we help with a pre-seed up to $100,000 in investment. And the way we deliver success, similar to today's topic, is that we're really communicating about funding-oriented programs. Having experts such as Andy and Robert accessible to you, who are investors, who know what's going on, and just giving you the straight and skinny is extremely helpful for you to figure out what are your next steps of your business. And if you're unfamiliar, Boom Startup has 4 main programs. Our first is our Pitch Up, which is our pitch competition. We just concluded that about a month ago. In fact, Andy was one of our finalist judges. And OpenUp is this program where we do these workshops. Rise Up are intensive closed cohorts that run for a week long in sprints, and they're all virtual online where you get an expert to go deep dive and help you solve a really important business problem. And then, of course, AmplifyUp is our funding program where we leverage SPVs provided by Assure. So not only do we get to invest, but we also pull in our angel investors as well as your angel investors into the round and keep it really clean on your cap table. Now, with no further ado, I'd love to introduce the mentor experts. Both Andy and Robert have seen well over 1,000 startups combined, you guys. And they have groomed, they have backed, and they have invested into hundreds of startups. So when it comes to deal creation and deal closure, as well as deal failure, these two people always come to the top of my mind on who to speak to as to what's going on and where things work and where things fall apart. Robert, let's start with you. Currently, you're a venture partner at IdeaShip. You've also currently run the 1 Million Cups here in Salt Lake City, and you've also done several incubators and accelerators yourself. Would you mind just sharing a little bit more of your personal history that's helping out the entrepreneurs?
Yeah, absolutely. So I've been involved in the Salt Lake startup scene for about a decade now. So I currently operate as the kind of day-to-day operations venture partner at IdeaShip. So I look at all the deal flow and provide, portfolio monitoring and coaching and get approval from our investment committee. So I'm a little bit new. I'm not as seasoned as Andy is, so I still look to Andy more often when I've got questions. But I've been doing IdeaShip for just about 3 years now, and it's a hybrid services for equity directed cash model. We pay particular attention to patents and kind of funding the value behind the company. And it's been fun, interesting, and I've learned a lot, and it helps bridge my gap between helping and supporting the community. So I started Sustainable Startups about 8 years ago, I believe, and we had a co-working space, and really Salt Lake didn't have a lot of places for entrepreneurs to go. And so we brought the 1 Million Cups program to Salt Lake, and we had an empty co-working space, and we're just sharing cups of coffee, getting people talking about what they were up to. And so we've continued to kind of grow that into a larger community. I don't run co-working anymore because there's lots of it here in Salt Lake, and people like Tara and Boom Startup doing great incubators. But I've always found that what I love to say about 1 Million Cups is it's like a community of entrepreneurs getting together, like the bar Cheers. Sometimes people aren't old enough to know that reference, but another way I think about it is like AA for entrepreneurs, right? It's people coming together, sharing their problems, talking about it kind of in a non-judgmental way. So that's what my love and passion is we need people to get together just to talk about what they're up to. And I have the good fortune to be able to do it through a venture capital perspective through IdeaShip, but really it starts at this level with Boom and just people getting together and executing and trying to test ideas, because I think for me, that's where a lot of this value creation comes from, and it starts.
And a little fun tidbit about Robert is that part of his passion is social impact. You started your career with the Miller Group, correct?
Yeah, it was one of my big stops along the way for sure. And that was part of my coaching. So I worked with the Larry H. Miller Group as the general manager for their culture arm called Miller Inspiration. So really helping understand the values and the foundation. We wrote a couple books and trying to get people to grow. And it pairs really well with what I was doing with entrepreneurs, which is helping them understand their foundation, right? So money is a great motivator, but it's not the only reason we do things. And so Sustainable Startups and Larry H. Miller were kind of my foundation to help people get their feet set and understand what they build on top of that foundation.
And this is very important for our Boom Startup community members. If you have a social impact aspect, Robert is absolutely a very valuable resource to speak to, because he's seen so many different sorts of programs and executions, as well as what gets funded and is sustainable, because oftentimes those are very trying sort of financial approaches. So Robert's a fabulous expert on that. Thank you for being with us.
My pleasure.
And And next we have Andy Jorgensen. I love to say he was my first friend in Utah when I moved here. And Andy has quite an extensive background, and I would say he's one of the most prolific angel investors in Utah, and has been doing this for quite a while. Not only is he with Salt Lake City Angels, or SLC Angels, excuse me, but he also created Lighthouse Investments and is running that himself. Weren't you also the co-creator of VentureWorks, Andy?
Yeah, way back when.
Yeah.
It originally started to kind of help companies with marketing as they tried to find product market fit, right? So a very data-driven, iterative process to finding out, if you don't know who your core customer is and what kind of messaging they're going to respond to, we would just kind of deep dive into that whole aspect of your go-to-market strategy to unlock where your sweet spot was, right? And one of the things as investors we look for is traction, and trying to get you that early traction that investors are looking for was kind of our mandate there. But to elaborate on what you just said a little further, I've been angel investing for a while now. I've got about 90 investments in the portfolio. That doesn't qualify me to be a super angel yet, but as soon as I cross 100, then I'll get that special badge on my my LinkedIn profile. Or
bigger halo.
Yeah, bigger halo on my angel list profile. The key, kind of takeaway about me is I come from the tech sector. Obviously, recurring revenue models, whether they be product-based or technology-based, is a big thing these days, right? That's one of the things investors are looking for is a recurring revenue stream, and obviously your company is valued higher based on setting something like that up. So that's another thing to kind of think about in your background. Like, there's people who have been able to create multi-million-dollar businesses out of taking something that used to be, a retail or consumer-based product and turning it into some sort of subscription model, or, think of the BarkBox and Chewies of the world, right? Instead of going to Petco to get your dog toys, now you're getting your dog toy in the mail every month, and these companies are now worth, millions and millions of dollars, whereas, this was something that wasn't a thing just a couple of years ago. So.
Well, and Andy, I've always admired your marketing experience and intelligence, especially with go-to-market strategies. But there's more to you than that. For example, sorry, it's probably hard to see, but you've done the blockchain incubator back in the day when that was just crawling up, and you also are with Ogden's Own Distillery and one of their board members. So you have such a varied expertise, ranging, several different categories and industries and business models.
Yeah, and to elaborate on that, it's every business out there, you have an opportunity to make them data driven, right? And in the case of the distillery, it's a great case study from taking something that is kind of a blue collar craft industry and applying some of the metrics that tech companies use, like customer acquisition cost and lifetime value, and being able to like measure the metrics of the business. You're taking a product company and you're applying some of the rules that other businesses use to measure themselves to that business. It's not always a one-for-one, but sometimes applying these sort of different drivers of the business can pay off huge in dividends and allow you to make better decisions, right? That's really what it comes down to. You're a startup, you have limited resources, you have limited time, you have limited capital. So how can we get you to make the best decision with what you have available for you so that you're not wasting time and not wasting money and getting the most bang for your buck.
Well, thank you so much for being part of this. To the Boom Startup community, Andy is a fantastic research. He's a really good gut check from KPIs, go-to-market strategies across the board. Please feel free to leverage him. All right, let's move on to our topic. Actually, wait, Christina, you see a question?
Yes, there's a question in the chat and it's asking, does recurring revenue always equal subscriptions for investors and angels, or could it also be repeat purchases of products?
I think a repeat purchase of products is great, right? If you can drive people to wherever your outlet is. Say, I go to the store and buy milk and eggs, right, every week. That is considered a recurring thing, but there's no guarantee that I'm going to go back to the same store. I might go to Smith's, 1 week, and I might go to, I don't know, Reams or Macy's the next week. So it is a recurring purchase, but it's not necessarily the same as a subscription. A subscription takes it to the point where you're locking in the buyer and the seller into a relationship with each other. And that's one of the things investors look for, is that locked in sort of guarantee.
Thank you. All right, for the newbies who are on this call, we're going to be throwing out some terms. We're just going to set expectations now and introducing some terms so that as the conversation goes, everything makes sense. There are 3 types of capital that you can attain as an entrepreneur. The first is non-dilutive. The second category is dilutive. And non-dilutive and dilutive strictly reference your ownership of the company. So it's either not diluting your ownership or diluting the ownership. And the other one, the last one, is debt. To be very specific, you'll hear certain terms or exchanges for the capital that fall into these categories. So always have this sort of perspective in the back of your head. For example, non-dilutive are things such as the pitch competition. The winner just gets $1,000 cash and we're not getting exchange of their company ownership. Same thing goes with grants. Fabulous resources. Of course, they're time intensive because it's really hard to get free money, but it's certainly worth it. And it is a viable form of funding. In fact, I worked with a company that raised over $200,000 in non-dilutive pitch competition winnings, which basically funded their first 2 years. So important category, but we're not here to talk about that today. We're actually here to talk about dilutive, because this is where you get to dilute the ownership of your company to pool on investors such as Robert and Andy. And you can do dilutive through crowdfunding or through price rounds, and we'll go through that in a bit, where all of a sudden Robert and Andy become shareholders. Or you can do dilutive through a convertible debt, which are convertible notes or safe agreements. And those are often the very first used instruments in pre-seed rounds, because the reason why you're not setting a valuation on a company, most likely it's because of what Andy was saying. You really haven't figured out exactly what your recurring revenue or your substantiated revenue is going to be like. And then, of course, there's debt. Personal credit card and corporate credit card. I'd love to just ask Andy and Robert real quick, how many convertible notes and safe agreements have you guys both participated in? Because I think that's where our conversation will be today.
So on my side, our fund, out of Fund 1 and Fund 2, we've done, I think, 54 investments. I've been involved probably with just over 40 of them now. And breakdown wise, our majority are safes. Most are pre-money safes. Seems like more recently we've been moving to post-money safes.
And can you explain pre-money and post-money safes real quick? Sorry.
Yeah, so for everybody, Y Combinator put out the safe a number of years ago, probably 7 or 8. And that original version was the pre-money safe. So you had terms set up and the calculations were based on the terms was all the pre-money valuation, and it depended on down the road on the next financing that those terms would help you calculate what your investment was worth. Y Combinator now, the only one available on their website. I think Carta offers both in their platform, so you can do pre or post money if you're using them and their tools. But right now, Y Combinator's only got up a post money safe, and so all the calculations are done based on what the round would be after financing ahead of time, so that it's not as complicated and confusing for investors. Sometimes you don't know what you have in the pre-money safe until it's all said and done, which makes it less interesting. I'm sure Andy's got some thoughts about that based on how many he's done over the years. So that's the difference between pre and post. And then convertible notes. Our fund uses convertible notes, but we usually only do it if that's the existing round that's happening and the terms are already set and we like them and it makes sense for us. We think of ourselves as a founder-friendly fund, and debt, convertible note shows up as debt and it's a little bit different. And so we just edge towards safes because of how our fund's set up and our preference, and to make it easier. But there's pros and cons, I think, to both.
Yeah, and I would say that like the wind blows in different directions every couple of years. Like for a while, we'll see just only convertible notes, and then it'll be only safes, and then the pendulum kind of swings back and forth. The convertible note being debt until it converts is one of the things that usually has a trigger. Like usually the trigger is some sort of period of time or some sort of funding round that happens that has the convertible note actually convert, versus the safe will often have a situation where you, the founder entrepreneur, is in a little bit more control of when that conversion takes place. And there's lots of different flavors of each. And there's, as Robert said, pros and cons to each, depending on how you want to, set things up. For a while there, safes were all the rage, and then, some investors got burned by safes, so they started pushing back and going back to convertible notes. But convertible notes have their disadvantages as well. So, like I said, there's some momentum behind why the pendulum is swinging in each direction. But they're both something that you should consider as options for you when you raise money. They're both very, very viable.
Thank you. And
I have a question. This is Guy Latender, if that's okay. Hi, Andy.
Hey,
Tara. Hey, so is there a form of safe, and it wouldn't be called safe anymore, that's a priced round, but similar in simplicity? And is safe really considered a debt instrument?
I think that the structure around them goes for a cap. Usually in convertible notes, there'll be a valuation cap that if exceeded, the investor gets the benefit of that cap. Like very often you'll see like a $5 or $6 million cap referenced, and then parlaying that, there'll be a discount to the next round. So what that'll look like is, let's say it's a $5 million cap with a 20% discount to the next round. That ends up being sort of like a $4 million, give or take, valuation. If they exceed that on the next round. With part two of your question with the safes, are they considered debt or equity? I think most people consider them as a note, but it kind of takes away the option to repay the note in anything other than equity, right?
yeah, it's an unsecured debt, and we'll get to that in a minute.
Yeah.
Yeah.
So there is an option with a convertible note that you can just repay that note with the interest. right? And there are some entrepreneurs that actually go that route, and if their business is very, very successful, say they borrow, let's say $500,000, and they never trigger the conversion of the note, they could pay back that $500,000 plus interest and never can, and it becomes non-dilutive to them. It just acts as debt.
Yep. Good job, Andy.
Sorry, jump ahead.
No, I love that. Like, here comes the attorney speak. You can tell he's looked at these 1 or 2 times, huh? So for just like an overview, like if we're just going to look at the whole world and when it comes to capital accessibility, I love putting things on a 4-by matrix. So honestly, the indicators are like, where is your growth rate and where is your profitability? And by looking at this, you can commonly cluster capital resources along these lines, where when you're early, you're at low profitability, probably not even close to profitability, but yet you're picking up that momentum with a high growth rate. That's where convertible notes and safe agreements really play. But then when you have that, consistent and higher growth rate plus the higher profitability, well, that's when you get into your price rounds, like what Robert was mentioning before about the company, what it's valued at, the valuation. That's setting a price, or the price round. There's also private equity and IPOs, the end of the rainbow sort of thing. But if you're highly profitable, but you have low growth rates, you know what? Debt is probably the most likely instrument that you're going to use to access the capital. And then if you're low profitability and low growth rate, look at pitch competitions and look at those sorts of grants to help substantiate you until those sort of profitability and growth rates expire. Now, when we break this up into further terminology, and this goes back to Guy's question, safe agreements and convertible notes at a high level are grouped into unsecured debt. And what that means is that there is no collateral or promises or assets that the founders make to actually get it. So, they can take Robert's and Andy's money and give nothing back, like nothing can happen out of it. With a convertible note, at least there could be called like a debt, but safe agreements, there's none of that. And so safe agreements, like what Robert was saying before, are really more entrepreneur friendly than convertible notes, which kind of lean towards the investor friendly due to the ability to call it, as well as the payment of interest, which often convert into additional shares. Now, what happens is the unsecured debt converts into convertible preferred shares, oftentimes in a price round. So if you hear convertible preferred shares, then you're taking the money that and Andy and Robert gave you, and you're putting them into preferred stock and at the next investment point. And oftentimes when that next investment point happens, that's when you calculate how much ownership they got and how much stock that they got, because that next round valuation really does affect their conversion points. And as we mentioned before, non-dilutive grants and pitch competitions, they're not going to affect your ownership of your company. And debt is collateral backed, like on the previous or 2 slides ago, like you're putting against the equity in your house, or if you're like the Maloofs, you pull out $2 million in credit card for the line of credit to supply it, and you're just really smart on your payments. With 0% interest bouncing from credit card to credit card. So these are all the different routes. Andy, Robert, do you have any other comments that you'd like to make on this slide?
Yeah, and the credit card thing, right? This is like risky because it is high interest. It does affect your credit rating, and it can be, potentially damaging for you over the long term. And you want to make sure that you're not sitting there kiting your debt so that you're, taking out one credit card to pay off another, right? You want to, if you're going to use credit card debt, it is a viable tool, but I have seen people who are chasing their dreams run up a significant amount of debt that becomes unsustainable. And you don't want to put your own life or your own house, on the line for something like this. It's easier to fail and fail fast and go on and chase the next dream than it is to, be homeless, because being homeless is going to put you a long way away from chasing your next dream. So just be careful with the credit cards. And I myself am guilty. I founded my first company on an Amex card, and I funded the whole thing through that, with $500 in a dream. So I don't necessarily practice what I preach, but I will tell you, you have to be careful.
All right, and we actually have another question in the chat. Can you pay a convertible back early for high profitability, low growth companies? And is that frowned upon?
You can't unless the investor calls on it. So there's an investor clause that says you can't back out of it. The investor is the one that took the risk. And so the payback can only be triggered by the investor. So that's a great question.
Yeah, most of the contracts will have what's known as maker language, and you are the maker of the debt, and you give up a lot of control over what you can do and not do with that debt. But everything is negotiable, but those default boilerplate agreements are going to take a lot of the power away from you and give them to the investor.
Robert, what are the common negotiation points on unsecured debt?
So for us, and if you go to Y Combinator's site, they've got a docs thing that I think gives some good overviews and templates and side letters, but especially in SAFEs, but convertible notes, you've got the valuation cap. Andy mentioned that already. The discount. So those are two common ones.
What's a discount?
So the discount is you get a discount on the priced round that happens in the future. So if an investor comes in and values the company at 5 million and they buy 20% of your company, all the other investors before that would get. So if it's $1 per share, all the previous investors, if there's a 20% discount, would get those shares for 80 cents. So you'd be able to buy and have more shares for the money you invested. So that's what a discount is.
Are discounts and valuation caps often compounded, or is it an either or?
In our SAFE, the way it's set up, it's an either or. So you've got two options. And so we've seen it, investments and documents set up a different way. They're not usually compounded, but some people have compounded them. So definitely as you're looking at it, pay attention, as the entrepreneur, if it's compounding or not. Sometimes another funny thing that happens is the difference between a discount and a discount rate. So sometimes people will unintentionally think a discount rate is a discount, and you'd be offering up a lot of your company for very cheap. So hopefully you're working with people that would help you see that and not accidentally invert it and give away the company, because it's not good for anybody usually when that happens. But yeah, oftentimes you've got, say, a valuation cap. So I might have a 5 million valuation cap. And if the next round happens at $10 million, then the valuation cap would give me kind of a 50% discount or my price on shares. But if you had a 20% discount at the 10 million, then they'd be worth 8. So oftentimes, at least for ours, it's one or the other, and it just gives you options, right? Like Andy said, it's sort of investor friendly as, you get to pick and choose.
No,
so MFNs, so most favored nations. So sometimes if you're early, you'll put one of those clauses in, which means, hey, I think this is a good deal and I'll do it. But if you offer better terms to somebody else and have to give away more of your company, I want those same terms. Pro rata is something that gets negotiated. So the right to further negotiate, that one's less complicated usually. So those are a lot of the early terms that we see in these unsecured debts.
Oh, that's very helpful.
I think the two biggest are most favored nation. That's, if you're making, tremendous progress or not, right? Maybe your fortunes are waning, and you have to raise more money or bridge or something like that. That's where you have to pay attention to those most favored nation clauses, because if you're desperate, you might be inclined to offer better terms to a later investor, and those most favored nation status preclude you from doing that. So,
Christina, go for it.
Yes, there's another question. Venture debt isn't covered here. Is that the same as convertible?
No.
It kind of fills into that orange category there. The
It's
collateral
some
back.
of it's newer, right? Too. So like some of it's like revenue based, right? So you've got they'll take some of your recurring revenue and back it against that. You know, Shopify does some, and Lighthouse. So there's a number that will do like revenue based financing. And so if you've got enough of that recurring revenue, you can take a more debt based approach. But yeah, it's more collateral back than.
Yeah, we have friends in Lendio and Appio, and it's basically instead of a collateral being a physical asset, it's on the contracts that you have within. And so it's certainly more in that debt bucket.
Right.
Great
But
question.
with those, you might have to set up some sort of lockbox on your account that restricts access to your money, right? So one thing startups need a lot of is capital. And with those sort of debt agreements, you might be restraining your own access to your own money to fulfill those agreements. So just keep that in mind. Somebody else is controlling your cash now.
Great question, whomever that came from. Oops. Oh, goodness. All right. How am I driving? I went one too far. Choosing your investor. All right, this is the right slide. Okay, so moving on real quick. The very first thing that's important is that you need to be able to choose the right investor. Andy, you always talk about investor screening and having frank conversations before diligence begin. Can you just explain why this is important?
I think it comes back to it's not just about taking money. It's taking money from the right people. You know, there's angel investors out there, and we have our little wings and our halos, and we float around writing checks to people. But there's also, you know, what's known as vulture capitalists out there. And, you know, some of those guys, you know, they're not all bad actors. Some of them are just, you know, they've been burned a couple times before, so they want to ensure that when they invest in you, they get a payback. But there's also people out there who will engineer financial tricks to, you know, take over your company if it becomes successful. So it's important to research who, you know, you're taking money from, who have they invested in before, what have the outcomes been, you know, what kind of things do they invest in. Just because somebody has a deep pocketbook doesn't necessarily mean that they can help you in your business. Part of one of the things that you look for as an investor is how to open up new doors, new windows, new connections. You know, the other things that an investor can bring to the table are relationships besides just money and knowledge. It's getting you in touch with the right people for your business. So all this kind of falls into that, you know, be careful who you take money from, and make sure that that money is going to add more than just checkbook value. It's going to add knowledge and relationships.
No, it's right on. And then if we look at expectations and like figuring out the exit plans, not pans, Robert, what happens when investors and entrepreneurs are not on the same page?
Well, I think it's building on exactly to what Andy just said, but almost the opposite, right? So we've got these investment agreements that give the power to the investor. So if you're not on the same page with your investor, instead of it being a value add conversation and more than just the money, right, connections and opening the doors, then it becomes more about contractual and trying to limit exposure and risk. And so you're having a very different conversation, and you're not able to add value. Now you're just trying to keep your slice, if anything, right? So spending more time having difficult conversations and contracts, and lawyers get involved, and that gets expensive. And so, you know, for us, it's really important for fit with the team and being on the same page. We talk about fit a lot, two-sided fit. So, you know, if you're spending time arguing over terms or agreements, then you're not spending time building your company, and it's not good for anybody.
Well, and I think it's also fair for entrepreneurs, and it's their responsibility to figure out what is the investor's expectations on the exit, right?
I think absolutely, that's a conversation to have up front and talk about, again, both where you're going to put the money and and where it's going to go and how much money you need to raise, right? So one of the things that I see is sometimes entrepreneurs aren't willing to show all their cards or be honest maybe with themselves or their investor. They're trying to look good instead of share what's the reality. And so when things get hard and you're not on the same page and you learn about some of the things that maybe were happening before, and or even when things get tough, and if the entrepreneur is not sharing, hey, things are getting tough, and looking for a little help, it makes it even harder for people to be on the same page. And so I think that's definitely an area that entrepreneurs, instead of trying to polish a turd, so to speak, if it's a turd, it's a turd, and raise money on a turd. People will still give you money, but it's better to raise money on it with a big hope and know it's a big bet, and do your best, than it is to try to pretend it's something other than it is, and take that money and then have to deal with it going sideways after that, right?
Yeah, no, honestly, it's not what you raise, it's who you raise it from.
Yeah, there's another piece to that, right? And it comes down to the investor pitch. Like, don't come to the table and say, Google's going to buy us, or Apple's going to buy us, or one of our possible exits could be to XYZ company, if it's not realistic.
Mhm.
Don't oversell what your exit possibilities are, because an investor will see right through that, and you'll be diminished in your pitch if you do. So, definitely look at your exit plans and make sure they are realistic.
All right, let's talk about the investor's point of view. I think this is going to be the most helpful for everybody. Payback is something ubiquitously discussed, as well as growth rate and the risk of the deal itself. Robert, every investor has different filters, right? But what are the investor fundamentals when it comes to screening deals, like from an investor point of view?
Yeah, good question. So from our perspective, risk is one of those big things, right? So I think, and Andy mentioned it earlier, but having evidence to back up, right? Your go-to-market strategy, the tests you've had, the recurring revenue, all those things help lower your risk. I think most investors evaluate the financials, right? They'll put it into their model and look at their IRR, their internal rate of return. They look at payback and growth rates and the size of the market. So all that stuff is true, yes. But for us, we look at risk, and risk for us, we look at it from like the technical side. So we're a patent capital fund. So we look at what their IP looks like and how differentiated it is. So we evaluate the IP by itself. We look at the team. There's team risk, how many people are on the team, how long have they worked together, have they had success together before separately. We look at, have they had any hardships to date, right? How have they handled that? Because like stuff gets hard. So if we can look at how they managed that previously, right? And then just how easy they are to work with during the screening process. When I get somebody making lots of demands and not following up on emails and doing stuff, we've got a rubric where we rate them difficult to work with, which changes how we interact with them. So those are definitely some things that we look at and how we look at them. Yeah, there's the market and the go-to-market and the size of the market and the paybacks, but frankly, we run those numbers, but we spend much more time on the less tangible assets and what that looks like and how people are working together.
No, that's really interesting. Now, Andy, from your perspective as an investor, what warning signs are signaling risk, and it's just diminishing your interest?
Whew. I mean, it's hard to categorize what the warning signs are. Sometimes, as Robert just alluded to, sometimes it's team, right? And hey, I just started this company with my college roommate. Maybe they're not the best fellow team member, or there's a stereotype about husband and wife teams, although I don't know that it's 100% true, but that comes into play. Then when we look at sort of like an IP portfolio, that's one of the assets that Robert's talking about looking at, and very often you might not even have a fully fleshed out IP strategy. because it is early on, and lawyers are expensive, and you know, you don't know how to start, because you don't necessarily have a patent degree, and you might not even know what you have that is patentable or protectable. And so we kind of have to sift through those things. We have to work with you to sort of develop, you know, how to kick your college roommate out of the company you guys founded together. And you don't want to be, you know, Machiavellian like the Facebook, the way that played out. But you also, you know, you want to be fair and make sure that you have the right team assembled, and make sure that, you know, they are, you know, committed to the right long-term goals, the right strategy going forward, and the right skill set to execute that strategy. And then I guess another warning sign is probably along the lines of coachability. I mean, that it's really hard to put that into any sort of quantification, but one of the things we look for is people who are realists, who can iterate on an idea, versus somebody who's dogmatic and very rigid. That's one of the things that we look at as you as an entrepreneur and a founder.
Yeah, no, and one of my aspects too is being prepared, which alludes to this next slide, which is investment readiness. And I would love to just pipe in here that, you know, if the team is not ready for the funding, then you are wasting time and you're never going to get a second chance to have a conversation again. And so these are the mandatory must-haves. And in fact, this is the DNA of Boom Startup. All of our programs are helping you on getting your incorporation right, your cap table right, agreements, financials right, etc. Like, that's why we're here, and for you to drop in, and you should like deeply engage with our resources to make sure that you're prepared. Because we're running out of time, I think we're going to save our questions till the end now, and let's keep these Q&A going with Robert and Andy. Andy, this one is a question that I get all the time, drives me nuts. Like, why won't investors invest in an LLC? Can you just explain it?
I don't know that that's necessarily true. I've invested in quite a few LLCs over the years, so it's not a hard and fast rule. I think there's a certain amount of preferential tax treatment that has come about in the last couple of years, especially around C corps. It used to be C corps were out of favor because the tax efficiency was not there. But now that they've moved the corporate tax rate down to lower than very often your personal tax rate, you know, the C corp comes in favor. There's also something called QSBS. I don't know if you've ever heard of this, but it's section 1202 in the tax code that allows you, if you organize as a C corp and run that way for I believe a period of 5 years, then your first $5 million of your exit is tax-free, which is pretty darn attractive, is to not have to pay capital gains on the first $5 million. So I think that's probably why you see the pendulum swing that way. But for me personally, I've got quite a few LLCs on my portfolio, and I sleep okay at night. So,
Robert, do you want to answer that?
Yeah, I mean, I think Andy's right. Mostly tax stuff, right? And depending on the pendulum. So we've got a couple ourselves. We do less of them these days. You know, it also, right, like the difference between a shareholder and a C corp versus a member in an LLC, right? And so there's also some governance stuff that comes in that makes it more complicated and messy for LLCs sometimes. So a lot of people, especially as you raise later rounds, often require conversion to put that larger amount of money in for corporate governance and other things. And so it's sometimes just easier to get it all done up ahead of time instead of having to deal with it along the way. But, we've made a couple of LLC investments with a request that they convert or know they need to, but we know they're going to need to anyway eventually. So we encourage people to do it and try to push them to before we get involved. But it depends, right? So if we feel good about it, we'll make the deal. But hopefully they're already organized, have gone through a boom startup and have all their ducks in a row in their deal room, right? So having an organized deal room and just being organized is another thing that we look for. Is like when somebody's super organized. I had a guy present pitches, right? So like he had videos of different lengths, how he explains his company, his deal room was all organized, and that just made everything so much easier and easier to trust and know this person is organized. And so all that stuff goes a long ways.
Yeah, and I would add on from the incorporation, the reason why we strongly urge just to be an S Corp is because the cost of the legality to transfer over the basically ownership to shareholders is absurd. It's something that could easily just be avoided if it's done in the beginning. And the worst thing is to ask investors that are giving you the money to raise and fix your like go-to-market strategy or your product or whatever, go to legal fees. And so if you can reduce legal fees by just having things set up correctly, not only is it easier to flow, but because you can actually calculate a share price, whereas there are no shares in LLCs, then that's our rule of thumb. That's why we're a little bit more sticky on that. Robert, I really like that you mentioned that the investment readiness is about the deal room. That I think is really important. So thank you for bringing that out. The one last part for you both to answer is the capital allocation plan, in particular with pre-seed rounds. We consider it as mostly a test to a first-time CEO with a first-time raise to see if, in fact, they can close the round and they can do what they said that they want to do and test the hypothesis. Do you guys mind adding on to like expectations for the first round versus follow-on investment rounds?
Yeah, my quick thought on it is it sort of goes back to one of the previous slides about risk, right? So for us, it's like an experiment. Can you raise and execute on that, right? So if you can, then it shows that, you can manage that risk and sort of put evidence behind it. So from us having a capital allocation plan that makes sense, that isn't just overpaying people's salaries and goes to something to help run a test, right? Sometimes you need so much money to run a test and people say, oh, I need this much money. It's like, well, you could run that same test for half. Like, why would you raise twice as much? Or, hey, that's not enough money to run. This is a test you're trying to run. You need to bring in more money because the test looks like this. So that's kind of how I look at it, is that capital allocation plan is you're going to run an experiment that you don't know how it's going to turn out. So having a plan, understanding that, and then trying to execute on it and dealing with whatever the results of that plan, that experiment are, as part of how you reduce your risk and our risk as investors.
Andy?
I got nothing.
Okay. We have
I can't elaborate on what he just said.
The next one is growth, and maybe we can just do this in just a couple of minutes because I know we have like 5 minutes left. It's been a great conversation. Growth is a very important perspective from the investor. How does, like, for example, the investment round affect the future valuation, Andy?
I think it always comes down to the performance metrics of the company, right? You need dry powder. Once you get a good product market fit and you start to really get your feel of that traction and you want to accelerate, I think you really want to be able to, double down or triple down with that gas that you put in the tank. There is such a thing as over raising, and I try to look at, okay, what's our runway? Am I only raising 6 months worth of capital? then it's probably under what you need. You probably want to raise, 12 to 18 months worth so that you can execute on what your plan is. If you raise much more than that, like, this is sort of a frothy market, and companies are getting oversubscribed with what their needs. So I go to market and say I want to raise 500K and I end up raising $1 million. I think that maybe it makes more sense to, stop the raise, take the money that you need for that 12 to 18 month runway, so that you're not so flush with capital that you're spending it inefficiently, right? If you've got, quote, mad money, you could potentially be spending that money on things that aren't accretive to the business and aren't moving the needle for you. Because, with $1 million in the tank, it's really easy to kind of go crazy and overspend at conferences, or overspend on marketing, or overspend on hiring even, and bringing on employees that are not going to move the needle for you. There's a lot of traps to over raising money that in a entrepreneur friendly environment that we're in right now, you could fall into.
Well, no, and I think that's really important. The other thing that I noticed, because it's just so swayed onto the entrepreneur side, is that there's a little bit of a laissez-faire approach with IP. Robert, how important is a defensible IP plan?
We could spend an hour talking about this because it's what I do every day. But just like everything else, having a go-to-market plan, like having one for IP, right? Not everybody needs it, but if you're doing something different, there's statutory bars, so you can only protect it so far, right? And knowing what you're going to protect when. So Andy mentioned it earlier, you might not even know, right? It's complicated. Lawyers are expensive. So I think even just pausing to have a plan and to find out whether you should protect it or not, and what the 1-year statutory bar in the US, so you can file a provisional, but there's dangers around filing those. So there's just, it's a part of your business that's worth learning, especially if you're doing something different, just so you can answer the question and make a plan for it. So I'm always happy to chat with people if they're curious about it. No investment required to share some perspective on it, right? So I'd say knowing it's a big part, and part of our thesis is oftentimes an exit or a merger and acquisition through an exit. IP plays a role somewhere between 10 and 50% of the overall valuation. And if, from our parent company, the broker's patent side, if the IP is not any good, oftentimes the deals fall apart because the company that's looking to purchase them, the IP is a big place of it, part of it. So it's hard because until you have the money and the experience to know it, when you're there, you usually miss your window to protect it. So it's worth thinking about early, I think. Not necessarily spending a bunch of money on it early, but being aware of it early is probably important.
No, and by having, really experienced advisors to help guide this part of growth, it's a really important component, like you said. And talking of growth, the most easiest way to figure out if you're growing or not is sales, right? Obviously we got to talk about the revenue stream. Of course, every single investor is going to care not only about what you've closed, but what's in the pipeline, right? Drilling into forecasts. Andy, can you just talk to us a little bit about revenue streams and how that helps valuation, and just that explanation or that insight, please?
Yeah, and this comes back to the type of business model that you're running, right? That whole concept of, investors are going to value recurring sales above what they value just regular sales, right? And this is something that it's hard depending on what your company is doing. If you're a services company, it's really hard to plan what these recurring sales are going to look like, versus if you were a software company, versus if you were a product company, right? And if you look across the spectrum, you see lots of different iterations on existing business models to do things a little differently to sort of play into those investors' appetites. I think one of the things that we look for on the investor side is adherence to your thesis. it's very tempting for an entrepreneur to chase revenue, like that sort of any port in a storm approach. Any revenue is good revenue. And one of the things that we have to unpack is, are you chasing things just because to land this big anchor customer and they're sort of driving the show? And if you leave them, disappointed, is 80% of your revenue gone with that one customer? So we look for sort of that, sustainability, repeatable process, and an ability to expand. If you're doing something for one person and one person only, is that one thing applicable to all your customers, right? Very often, if somebody's offering to write a big check for you, it's very easy for them to dictate, your product features and functions, or lead you down a path that might not necessarily be serviceable going forward.
Sure.
So it is a big risk.
No, that's so great. And, different revenue streams like services just don't get those multipliers when it comes to valuation, But Robert, the thing that you and I talked about a while ago was market creation or market competition. Like, are you coming in and disrupting an existing incumbent, or are you creating a new emerging sort of market? Why is that understanding and modus operative, important when it comes to business creation, as well as helping the investors improve their valuation?
Yeah, I mean, I think from my side, especially in pitches, we always see, here's the market, and if I just get this 1%, right, like it's worth this much money type of thing, right? So that's pretty standard. Sometimes people change how much of that market there is. But, when we talk about competition and who's out there, a lot of people, pick a big name and say, this is my competition, where it's not the case, right? So there's a lot of other people at smaller scales, right? Sometimes your competition is the status quo, or like doing nothing, right? Like, hey, I've got this really great thing. It's like, yeah, but like if I just don't do that, then that solves my problem too, right? So I think running the tests, the revenue that Andy was just talking about, like for us, these, back to risk and running experiments is like, okay, really understanding who your competition is and running a test as inefficient or as efficiently as possible, inexpensively as possible. Like, how can you run tests and understand what your market is? And again, the best way to know what's going on, look around, see who's doing what, so you have a sense of what their tests are and what rate they're running at. So you can use the rest of the market to give you a leg up and help you understand and design one of those first tests.
Yeah, no, that's fantastic. I think we just lost Andy.
I thought I saw him disappear.
Yeah.
Said he had to go. So he said thank you to everyone.
Oh, that's awesome. Oh, yes, we are over time. So, in fact, there are 2 other slides. Do you have a couple more minutes? And then we'll just
I can stick on. Yep. I don't have a hard stop today, thankfully.
Thank you. The next one is performance. And I think this goes back to what Andy was saying. In fact, the slide was like totally queuing him up, because it is about the KPIs, right? And I think it's not only your capability of tracking your KPIs, but more importantly, the rate of change. I've been asked this question several times, especially when I was fundraising, of like, well, is it accelerating, flat, or decelerating? Robert, if you have any color on this, that would be great.
Yeah, so sort of parallel but separate. A lot of early folks don't know their data, right? So I oftentimes when we invest in companies, I end up being sort of like a de facto CFO type, right? So like looking at the data and understanding it. So, in a perfect world, like pro formas and all this stuff is great. You need a financial model, but more importantly, the operation. So if you don't have a CFO, you're not a spreadsheet person, you can find somebody on your team, right? So if you're not that person, but you don't have that person on your team, it's hard to know whether you're winning or losing, right? And your rate of change, your risk, these experiments, right? Hey, we need to build this product, right? Having a product is great, but you also need to sell the product and do other things. And if you're not able to track that data, it's sort of like running blind a little bit. So you're just guessing, you're hoping, right? And that's okay. And it works out sometimes, but another way to de-risk for your investors is to have some data and to run some experiments and to look at those numbers and say, how'd it go? What's your churn, right? So Andy talked about customer acquisition costs and lifetime value, but how about like a repurchase, right? So we had the question on repurchasing. It's like, well, if you can prove, if you have data that shows this person came back and every month they buy something, like those are some interesting experiments, right? That you can track and know your rate of change. Oh, they did it so many times until we changed our price and that person hasn't come back since, right? So looking at your data and understanding your performance and tracking it is really important, because otherwise you're just sort of guessing.
No, I agree. And I think the other aspect is you got to track your cash, right? That cash flow, the runway is basically how many months you have until you're out of cash and in debt. And that's an indicator that you just have to track, because every month you're going to be making new decisions, and maybe you're having problems with collections. Like, tracking your KPIs and your sales is equally important as tracking the cash that you have on hand, because that's a vulnerability too.
Yeah. And budgets, right? Everybody's got one, but then the question is, how do you stick to it? And are you ahead? Are you behind? If so, why? Right? Like,
Yeah.
and
Yeah.
the
And
answer
then-
is usually like the next layer down, right? So you got to dig in deep enough to even understand the causality oftentimes of like what the cash issue is.
Yeah, no, and it's so funny because like sometimes you just have to lock spends, and, freeze accounts real quick until collections happen. The last aspect, and thank you everyone for hanging in on this longer than expected session, but I think this conversation is very good, is possible exits. And this is the aspect that I think entrepreneurs should spend the most time on, to see what else is going on around them, instead of thinking that it's, they're in an ivory tower and what they have is a very unique and singular opportunity for investors, because that's far from the truth. By doing research on possible exits, your predecessors in the space, as well as comparative valuations, absolutely huge to figure out exactly, who you need to bring on board and what kind of equity that you're going to have to give up, and when you're going through dilution. And Robert can attest to this, the most expensive round that you're ever going to do is your very first one. So Robert, can you explain a little bit more about, what you should look at as predecessing, exits, etc., and why that's helpful?
Yeah, sure. And like Tara said, one of your most expensive rounds is your first one. Another really expensive round is the down round, right? So when you're bridging and you're in trouble, those ones get really expensive too. And a lot of times that happens because you didn't forecast or think about your exit or what you needed to get there, right? I think Tara also mentioned earlier, service, type ones don't have as high evaluations, right? So a lot of people look at multiples on revenue, recurring revenue. Sometimes it's a purchase of your customer or your market, right? So sometimes people say, hey, this is a growing company, we don't want them to compete with us, or it's in a new market that we want access to, so we'll just buy them. And that's interesting, but not normally people's plans. So trying to think about who's in your space, who's the next tier up, how much money they're raising, are you competing with them or complementary to them, right? Obviously,
Sure.
We focus on IP as a fund. And so oftentimes from our portfolio of the early exits, IP played a significant role, right? Because they were doing something interesting, had it locked up, and the company that was slightly bigger than them found it interesting and was valuable to them to have as part of their enterprise value and strategy. And that's what opened the door for the conversation, right? So IPO is always possible. I think knowing whether you want to stick with the business and try to take it public is an important thing. There's some of Utah companies we've been hearing in the news lately that have gone public, a lot of public offerings this year. So that's definitely a viable option. But I think for a lot of folks, it's not a super realistic option. There's a lot of other opportunities earlier, and trying to be aware of those and what type of companies is something you should do. Like having the end in mind from the beginning, right? Like, how long do you want to be with the company is a good question that a lot of people don't say. Like, oh, I want to be here for a few years or a long time, or right? Maybe even, are you the right CEO to get it to a public company? You might be the right CEO to start the company and get it to 5 million, but what about 100 million or $1 billion?
Yeah.
And I don't have answers for that. You might not either, but having that conversation early with yourself, with your advisors, with your team, I think is really important.
No, I think you're right. You know, the maturity points and the prospective buyers at those maturity points, it's almost like, you know, it becomes your storyline. And what happens is, like what Robert was saying, you know, you need a Robert or a fractional CFO to plot your growth in those KPI and financial metrics to see like if you're actually approaching the maturity points that your predecessors went through for those certain exits. Some of my favorite decks are decks that have the ask, like, this is what we need. This is the experiment we're running and we're testing this because we think it's going to be fabulous. And we're hoping that it's going to give us the sort of insight and results to put us on this trajectory. And this trajectory is actually backed by these predecessing companies. And it just feels, as, you know, someone that's trying to create a negotiation table, you know, it gives me a sense as how long my investment needs to be in there. Or is there an opportunity for me to get like a secondary to come in at a later stage, like maybe a series B, but then I'll be at that 20 multiplier of my investment. And that's all I care about as an investor in my investor thesis is I just want to make 20x of what I put in. I don't care how long your playbook is, but when will my 20x expectation happen? Is it 3 years from now? Is it 7 years from now? Is it 17 years from now? And so having these predecessors and these storylines to say, like, I got it, I know where I need to be. And even if I don't got it, then we can adjust accordingly. Like, it gives me that sort of long-term fiscal confidence in you as an executive. What do you think, Robert?
Yeah, I totally agree. And, you know, I think some of our decks, it's in our rubric as well, you know, who the potential exits are, when they are, right? So even just the reasonableness around those, like, oh, I'm going to sell to Google. It's like, maybe, but probably not, right? So you might have somebody else along the way that's a better fit. And so just even seeing people think about it, understand it, you know, pay attention to who's raising their Series A and Series B in the similar marketers. Like, hey, we look like this group, but different. Oh, and they raised 16 million at this round. It's like, okay, like that's interesting. So I think paying attention to the market, right? And, you know, what your plan is and being realistic with yourself and your team and just getting people on the same page is super important.
That's awesome. All right, we have one exit slide. Now, Christina, would you mind reading the questions and then let's just answer them and then we'll wrap this up.
Sure. So we had just one left, and it was, if you're unfamiliar, what's a good place to start understanding how to plan your exit strategy?
Yeah, so if you're trying to figure out your exit strategy, I would absolutely start by Googling exits in your space and see basically who have invested in your space and then look at their portfolio. And usually on the portfolio page, they even say like acquired by or what have you. It's really easy to do some in-depth Google searches. There's also like investor resources. I hate to say PitchBook because they're more like Series A and on, but there's other resources like that. I mean, what do you think, Robert?
Yeah, I know PitchBook's not quite as accessible, but we use PitchBook to look at the market and the space, right? So again, if you don't have access, find somebody that can, right? Like, I think there's a lot of public information out there. You can look at the news, right? So tracking the stuff, who's in your space, who raised money. You know, in Salt Lake, you've got Beehive that's sharing the news, right? So just tracking that stuff and paying attention to the news is a good start. Google is not super hard to search, and then there's stuff you can pay for that makes it easier, market reports and PitchBook and others. But again, be an entrepreneur, be crafty, and find ways to get access to the data. Don't just, you know, throw your hands up and say, oh, it's hard for me to find. It's like, sure, it might be, but like,
I agree with Robert. I think the other aspect I failed to mention earlier is the power of LinkedIn. You can see when people were at companies, and if you know these companies were in your space and are no longer there, contact them, ask them what happened, especially if they had a senior title or they were an executive. People love to tell you the gossip and the juice, and it's just asking for like, you know, a quick 5-minute conversation and explaining like, hey, I'm doing my investor research right here. I saw that you're with company Acme and looks like you left it 3 years ago, about the time when it dissolved. Can you tell me what happened? you'd be blown away what ex-employees will share.
Totally. And I think one of the market research pieces to what Tara, you're saying now is like underused by entrepreneurs is picking up the phone, right? Because like even when we do our due diligence, there's a lot of like data and stuff we do on our back end, but we always try to call an investor of each company we do a deal with. And, you know, like even when it looks like a good deal, like we've been talked out of making an investment by an investor just by picking up the phone and talking to them. So you can do the same thing as like talk to a competitor, talk to, again, like who's, a lot of people are scared to call their competitor, but oftentimes those people are willing to share and help and collaborate. So I think picking up the phone for your research too is, you know, really a pretty big deal that is underutilized currently.
Thank you so much, Robert. And there are no other questions, correct, Christina? Okay. Well, thank you so much for spending 17 extra minutes. I think this conversation was super good and juicy. We have some amazing programs coming up in throughout the rest of this year, including how to build your addressable market slide on Thursday. And then on Friday, we have a mixer hosted by Christina herself. It's going to be absolutely hilarious, and it's online. So go to boomstartup.com, sign up for all of this fun stuff. We wish you well, and take care. Thank you.